Last week's non-farm payrolls report, we saw a second consecutive month where the SOM rule was triggered. What's that? Well, let me explain. The SOM rule is if the unemployment rate, 3-month average of it, rises by more than 0.5% over its lowest point of the previous 12 months, it means that the U.S. economy is in a recession. This has happened before every previous recession in U.S. history. And so coming out of the July non-farm payrolls report that we saw on August 2nd, the SOM rule was triggered for the first time since COVID. And we just had another report, the August jobs report, and the SOM rule was triggered for a second consecutive month. In fact, it moved from 0.53% to 0.57. So recession appears nigh. Maybe a slowdown is coming. Maybe this is just the Fed tightening too much and the market, or rather the economy, is trying to digest it right now. But if this is a garden variety recession, it's not COVID, it's not 2007, you probably look at an outcome where the market shuffles into a situation where it has previously, historically. Certain sectors do well, other asset classes do poorly. And so my question is, and perhaps an explanation here, is what would do well and what would do poorly? Historically, going back to 1980, in all the recessions since then, the top performing sector to be in is long-term government bonds, averaging a gain of 10.04%. The second best place to be, gold, averaging a gain of 7.07% during recessions. The worst place to be, I'm sure that no one finds this to be surprising, but stocks, emerging markets in particular, tend to do poorly, 11.77% lower. The U.S. down 9.27% during those 6 recessions since 1980. So I know that Dylan, and we've been giving Dylan a hard time about his long TLT positions, Tom, because it seems like it's a boring, easy trade and place to be. But if this is a market shift that's starting to gear towards, well, doesn't really matter what the Fed's going to do or who's president, it looks like there's a slowdown coming. The long end of the bond curve still has a lot of juice to it right now. I know there's been a significant rally since mid-July, but this thing really could just be getting started. And I know it's something that in terms of diversification, the 60-40 portfolio has been back in favor. In fact, 60-40 has been outperforming 100% bonds, 100% stocks this year thus far. So right now, if there are opportunities to still engage long deltas in the bond market, and quite frankly, even in gold, I think those are opportunities that people should be looking to exploit on a longer term basis here.
It's interesting that you think that way. Those are kind of like, I don't really have a gold position on, but I'm definitely short bonds here. I kind of want to be more short just because of, based on the size of the run up more than anything else.
I've been pulling teeth in gold for months.
It's hard.
Yeah, you know what? I traded gold when there were a bunch of earnings coming out. I wanted to avoid those. Volatility was high. It's still high. IB rank is 60. It's actually a little bit higher, but a monthly implied volatility is 16. I go against my own kind of set rules. You need to be directional in gold one way or the other. Selling premium there is a tough one with an IB of 16.
I feel like I've traded in how many recessions, you say, since the mid-'80s?
All of them.
6.
6. Okay.
There's been 6 since 1980.
Right. 6 since 1980. And I feel like, so I've been in the markets every single one of those recessions. And I don't think that I ever actually knew that we were in a recession when we were trading in a recession. As crazy as it sounds, I don't think that the idea that later on that we figured out it was a recession, because at the time we really didn't know we were in a recession, I don't think it mattered one bit to me. And I don't think that I ever traded with a position, a recession trade in place. For me, it wouldn't matter. You know what I'm saying? Like, I think that's just, I'm not sure who, like, I'm an efficient market theorist. So if we're about to go into a recession, then the market already knows that. That's why the bonds are at the high end of the range. That's why gold is at the high end of its range, because the market's already priced all this stuff in. Whether or not there's a few extra points in there, I don't know. And it's very well, it's very possible that that's there. But it would never change the way I traded. The reason I give Dylan crap is because the idea that you're buying bonds because you think there's a recession, to me, it's just insane. And the idea that you'd buy gold because you think, whatever's already known about this so-called recession is already priced into the bonds. It's already priced into gold. There's nothing left. So that's why, to me, it doesn't make any sense.
I like that we put Dylan in between us, because he'll plainly say I got into TLT because of Vecchio and Spivak. So we're both.
Well, I'm just trying to come up.
Hey, he's your problem now.
Yeah.
That's the way I look at it. It's a win for me.
Yeah.
Yeah. Listen, Druckenmiller has always said that the best economist he's ever met is within the stock market itself. And so when you look at the positioning in the market right now, in
Well,
terms of sector
I agree with
performance,
that's a fair
Right.
that's a fair statement. I mean, I think that's the way we think about the markets every single day.
Yeah. So you look at the positioning sector basis in stocks this year. How's technology doing, say, compared to defense or utilities? Utilities are doing great. It's actually all the recession type things that have been doing well within the stock market already. So when you layer on gold's performance this year, you layer in bonds performance this year, it's like we're already in that mindset right now. And that doesn't mean there's not more to come. But if I'm looking at how the sectors and how the asset classes have performed, it's pretty clear growth concern is the main mindset right now. And so if we find ourselves going deeper into this, gold has more room to run, bonds have more room to run. I wouldn't be fading them necessarily just because they've run up a lot here. But the market is giving us a pretty clear signal. When you look at the leadership sector by sector, we are on growth scare recession footing already. That economist within the stock market has been speaking to us for the past 2 months.
Okay. It won't change anything that we do, but okay.
Of course not.
I mean, it changes.
What's in there then?
It changes the narrative. That's all. I mean, it changes the macro narrative. It doesn't.
The sentiment is shifting, right? In June and July, it was like, what could go wrong? Everything's great. And now there's bricks in the wall of worry again, which may be good for a year-end rally, but for now, we're still digesting. And September's usually terrible, and it's been pretty bad so far.
I think he's done with you. Are you done with him?
You want to talk about the debate? We can talk about debate. You know how much you love politics, Tom.
Sure.
The
Is there a
audience
trade?
love
Is there a
politics.
debate trade?
Yeah, that was the question we got
Yes,
today. We can come up with it. Go ahead.
So the two modal outcomes right now are Republican sweep or Democrats controlling a divided government, right? Kamala with a split House in Congress, or Republicans get everything. If Kamala botches the debate tonight, this is perhaps her best chance to shift some of these polls that are moving away from her. If she botches this, I wouldn't be surprised if the market begins to take the Republican trifecta narrative on. And Tom, if you want your short bond position to work, that would be the best case as far as I'm concerned. Unfettered one-party control in either direction, Democrats or Republicans, is going to be hugely expansive for deficits. If Trump gets his tariffs, that's going to be also highly inflationary. If he gets his deportations, getting 10 million people, 1 out of every 31 people walking the streets out, the people who work the lower income jobs, probably going to be inflationary. So lower bond prices, higher yields. If it's a crushing Trump win tonight, I think bonds are going to get crushed the next few days. So that's what you should be looking for, Tom. You want your bond position to work? You're rooting for a Donald J. Trump debate win this Tuesday evening.
I am definitely.
Couldn't love you more right now.
For the sake of my own sanity and for the sake of our
You
democracy.
can take off your bond position then? Show some support?
Oh, I still think bonds are going down no matter what. But for the sake of our democracy and for my sanity and for all the people around me, let's hope that's. First of all, it's not even possible because it's intellectually not possible. I'm not too worried about that. I'm more worried about.
You want to roll the $20, show me?
I'm more worried about how we look in the face of the rest of the world after tonight, not about which candidate comes out of this thing.
Why do you say that? We had 4 years of him already. I mean, what changed? I mean, the sun came up, the bus came on the corner.
Sun comes up no matter who wins.
Exactly, that's my point.
Bus comes around
Why
the
make it
corner.
such a life and death thing?
It's not. I just said, you asked me how I felt. I told him. It's not a life and death thing. But I mean, yeah, sun come. I don't. This country will prevail over everybody. It doesn't matter who.
Agreed.
Country always prevails.